Hey everyone, welcome back to the Trading Desk. I'm stepping into the role of your financial mentor today, and man, do we have a fascinating explainer lined up for you. We're sitting down to review a student's highly active, 1-month Demo MetaTrader 5 hedge account from XM Global Limited. If you've ever wondered what it looks like when raw enthusiasm collides with the volatile reality of the Forex markets, well, you are definitely in the right place. We've got the data, we've got the history, and we're going to break down exactly what went right, what went wrong, and what absolutely has to change before the student risks any real capital.
Okay, let's dive into this. 1,127. That staggering number represents the total trades executed by our student in just a single month. To put that into perspective, if you're trading 5 days a week, we're talking about roughly 56 trades every single day. I mean, this is the literal definition of hyperactive trading. It paints a picture of a student who is just glued to the screens, hunting for every single micro movement the market makes. But as we're about to see, constant activity doesn't always equal efficiency. To make sense of this massive log, here is our game plan for today. We'll start at the trading desk, look at a tale of two pairs, hunt for the highest profits, uncover the danger of drawdowns, and finally, wrap it up with the mentor's final grade.
All right, Section 1, welcome to the trading desk, establishing the context.
Moving right into Section 2, a tale of two pairs, the student's focus.
You know, when you're handed over 1,000 rows of raw trade data stretching from late March to late April, your very first job is to find the common denominator. It's a crucial proving ground. We have to separate the promising strategies from the, destructive impulses. We can see the time of execution, the symbol, order type, the volume, which is quite small at 0.01 lots, and the profit. And as you scan down that symbol column row after row, a really clear pattern just jumps right out at you.
Despite the absolute frenzy of execution, the account is almost entirely monopolized by just two major pairs, the US dollar-yen and the pound-dollar. Now, hyper-focusing on highly liquid majors, that's actually a great way to learn price action. But executing over 1,000 trades on just two pairs in 4 weeks, that implies our student is jumping in and out of the market on the absolute smallest time frames. Which brings us to Section 3. Hunting the highest profits, analyzing the wins. Now, before we get too critical, let's examine what actually went right. $292.22. Now, what's really interesting about this peak number is that it represents the single largest profit trade in the entire month. Finding a trade that yields a return like this shows us something really important. The student is totally capable of identifying a strong setup, letting it run, and capturing a significant move. It proves there's a really solid, profitable trader somewhere inside this hyperactive student. Get this, the student successfully strung together 21 consecutive victories, netting a maximal consecutive profit of over $360. That is highly commendable. It requires a strategy with a really high probability of catching short-term momentum. But look closely at that last metric. The average profit trade is just $2.46. This tells a completely different story. A story of relentless scalping, just taking tiny bites out of the market over and over again. It's an incredibly grueling way to build an account, and honestly, it requires absolute perfection in risk management. And that leads us directly into Section 4, the danger of drawdowns, structural flaws. So here's where we kind of have to face a harsh truth. A high win count, or even a 21-trade winning streak, it's basically meaningless if your risk isn't managed properly. When we break down the win-to-loss ratio of all 1,127 trades, the illusion of those winning streaks completely fades away. Profit trades make up 49.6%, and losses sit at 50.4%. The ultimate hit rate was, for all intents and purposes, a coin flip. And here's the golden rule. When your win rate is 50%, your winning trades absolutely must be significantly larger than your losing trades. If they aren't, you will just slowly bleed your account dry through the spread and commissions.
And this brilliantly illustrates the strategic misstep we're seeing. Look at the dichotomy here. The long trades were successful about 57% of the time, but the short trades, they won a dismal 37% of the time. So what does this tell us? It tells us the student was almost certainly fighting a really strong upward trend. Instead of just riding the momentum of the market, they were constantly trying to guess the top, and they were getting run over by the trend roughly 63% of the time.
Which leads us to what is easily the most devastating number in this entire explainer, a 53.87% maximal balance drawdown. That equates to a massive loss of $513 from the account's peak. Guys, a 53% drawdown is a fatal flaw for any trading account. Psychologically, it just crushes you. Mathematically,
It's even worse. If you lose half your account, you don't just need a 50% gain to get back to even, you need a 100% return just to break even. This single metric proves without a doubt that the student was trading without strict stop losses.
And the losing streak metrics show us exactly how fast things unraveled. The student suffered 19 consecutive losses, wiping out over $164 in just 13 trades. While the average loss was pretty small, at around $2, the sheer volume of these losses entirely erased the hard work of that earlier 21-trade winning streak. I mean, this is the textbook definition of taking one step forward and two massive steps back.
All right, let's bring it all together in Section 5, the mentor's final grade, the verdict.
So, we have to ask the big question. Would this account actually survive the real market? The harsh reality? Absolutely not. No way. You see, demo performance is entirely insulated from the true psychological terror of watching your real, hard-earned capital vanish. If a student allows a 53% drawdown on virtual money, the emotional panic in a live environment would almost certainly cause them to blow the account entirely.
So the crucial point is that to improve, 3 absolute rules need to be enforced moving forward. Step 1, reduce this hyperactive trade frequency. Quality over quantity is paramount here. Step 2, stop forcing short trades when the data clearly shows the trend is heavily punishing sellers. Just ride the momentum. And step 3, the absolute most important rule, implement strict stop-loss rules. You can never, ever let an account slide into a 50% drawdown. Capital preservation is always job number 1.
If you take away anything from our explainer today, make it this. A 53% drawdown is a structural flaw. Your high win count simply doesn't matter if your overall risk profile is lethal. You can have a beautiful strategy, you can have massive winning streaks, and you can understand currency pairs inside and out. But risk management must always, always come before profit hunting. Because if you can't protect the downside, the upside is just an illusion. As we wrap up this mentor session, I want to leave our student, and honestly all of you watching, with this final thought to help evaluate your own financial discipline. Can you tame the chaos of over 1,000 trades into a disciplined, profitable system before you go live? The potential is absolutely there. Those big profit hits prove it for sure. Now it's just a matter of mastering the risk. Thanks so much for joining me at the trading desk for this explainer, and I'll see you next time.